Hello and welcome to one and all. In today's class, we will move on to the next LAQ, define national income and explain the various concepts of national income. So this is from Unit 7, National Income Analysis. Okay, so this is also one of the important 10 marks questions frequently asked in the board exam. Okay, so to start with, you have to write what is the meaning of national income. So what is the national income? So the meaning is national income is the total market value of all goods and services produced in a country in a year. Okay, so you have to, it's better to mention the any definition. Okay, here I have mentioned the definition by Marshall because the question is define national income. So according to Marshall, the labor and capital of a country acting on its natural resources produce annually a certain net aggregate of commodities, material and non-material, including services of all kinds. This is the true net annual income or revenue of the country. So how the goods are produced? With the help of land, labor, capital and of course the producer. So that's what Marshall has said. The labor and capital of a country acting on its natural resources, that is land. So produce annually certain net aggregate of commodities. Okay, so how we have to find the market value of all the goods and services? So when you convert the national output with the price of the commodity, that is when you convert the national output in monetary terms, then that will become the national income of the country. Okay, see for example, see what is the meaning of national income? Total market value of all goods and services produced in a country in a year. This is just I'm giving you brief side by side. I'm giving you briefly the explanation along with the answer. Okay. Now the total goods and services produced in a country, that is equal to the total national output of the country. So the same total national output, if we are converting in money terms, so how do we convert it in money terms? By multiplying with the market price, that is price into quantity, that will become the national income. See for convenience, I am giving you an example. Let us assume there are only two firms in a particular country. So firm A produces and sells pens, okay, and firm B produces and sells pencils. Okay, let us assume for the time being, for a simple understanding, there are only two firms in a particular country. So the firm A is producing 100 pens and the firm A is selling charging 10 rupees per pen, and firm B is producing and selling pencils, 100 pencils and charging 5 rupees per pencil. Now the total national output, because we are taking only two products in this particular peculiar country, so the total national output is 100 pens plus 100 pencils, that is equal to 200 units. Now what is the total national output in this country? It's only 200 units. That is the total national output in physical terms. Now we have to convert it into total national income. Okay, so if we have to convert the 200 units into monetary terms, then we have to multiply with the price of the commodity. So how do we, then we will get the total national income. So now how do we arrive at the total national income? Price into quantity. So the total value of pens is 1000 rupees. How? 10 rupees is the price of pen, multiplied by quantity, so 1000 rupees. Total value of pens, 5 rupees is the price per pencil, and multiply with 100, then you are getting 500. So the total value of pens is 10 rupees per pen, multiply with the quantity, that is 100 pens, it is equal to 1000 rupees, and then total value of pencils, 5 rupees per pencil, multiply with 100 pencils, then we are getting 500, that is the value. Now you add both this, so total we are getting rupees 1500. So rupees 1500 is the total national income, which is equal to the total national output of 200 units, pens 100 and pencils 100. So this is how, so in a particular country, it is not only pens and pencils, you all know that so many innumerable varieties of commodities and services are being produced in a particular country. So each and every commodity or service, they are having their own market price. So how much quantity produced by each and every individual seller and also the government and also whatever commodity or service we are importing from abroad. So all those quantity multiplied with the respective prices of each and every commodity or service, then we are arriving at the total national income of the country. So this is the meaning. National income is the total market value of all goods and services. So the market value of all goods and services is nothing but all goods and services multiplied with their respective prices, then that gives the market value of all goods and services, which is equal to the national income of the country. Now this is the meaning. Okay. Now before I proceed with the concepts of national income, the second part of the question is explain what are all the various concepts of national income. Okay. So the concepts of national income, see, the analysis of national income is useful for a particular country to know the status of the country in so many angles. Okay. So according to the requirement, each and every concept is used. So the national income gives us so many information. Okay. How much the country is producing within itself without importing from the other countries. Okay. What is the domestic capability or the domestic production of the country, and how much the indirect taxes are paid by the firms, and what is the value of the output at the factory level, how much it is changing when it is reaching the market, and what is the difference between the gross product and the net product. So if the national income of a particular country is calculated every year. Okay. So what is the value of the output only for this particular year. So, and what is the value of the output grossly, and what is the per capita income of the country, what is the standard of living of the country. So like that, so many information can be got from the national income statistics. Okay. So according to the requirement, so many concepts are being used by all the governments all over the country. So those concepts are very useful. So that is the question, what are all the various concepts of national income. Okay. Now before I proceed with the concepts of national income and the answer and the actual answer, you have to understand certain points. Okay. So if you understand certain concepts basically, then it will be easy for you when I'm explaining the answer in the written form. Okay. See, first thing you have to understand is the national income of a country can be referred as the gross product or the net product. Okay. So now that is gross national product or the net national product. Now what is the difference between the gross national product and the net national product? See, for example, I told you the national income of a country is being calculated every year. See, for example, if we want to know the national income, the total national income of India only for 2023, then we have to know the net national product of India. See, now, see, we are using so many, for example, you take the metro line. So many bridges are there, so many factories are there, and so the railway lines are there, the infrastructure of the country. So all those things we did not construct only in 2023, isn't it? All those infrastructure, the irrigation projects of the country, there are so many assets, the capital assets in the country, isn't it? Just like a firm is having one machinery. So if the firm is having one machinery, every year the firm is not changing the machinery. Or to put it very simply, for example, you are buying a vehicle, you are buying a car or a scooter, a two-wheeler or anything. So for example, you have purchased a car. Okay. So let us assume 5 years back you have purchased a car and you paid around 8 lakhs for that particular car. Okay. Now 5 years later, can you say the value of the car is equal to 8 lakhs? See, when you purchase the car, the value of the car was equal to rupees 8 lakhs because that was brand new, and you have paid 8 lakhs because the value of the car is worth rupees 8 lakhs. But 5 years you have used the car. So there will be certain kind of usage you every year frequently periodically you keep giving the car for services and all, so you are paying certain charges for that, isn't it? So when the any commodity for that matter, any asset for that matter, if it was brand new, it is the value is okay, but then over a period of time the usage, it keeps on the value of the asset keeps on reducing. So 5 years before, if the value of the car was equal to rupees 8 lakh, currently it will become a second hand, isn't it? Now the value of the car would have been only say for example 7 lakhs or 6.5 lakhs, isn't it? So that means what, in the same way the country is using the capital assets continuously. Every year the country is not changing the capital assets, the pipelines, the oil pipelines, the factories, the steel plants, the irrigation projects, the power lines, the railways, the bridges, everything over a continuously it has been used for year after year. Over a period of time, the value of that particular asset would have lost its value because of its continuous usage. So then, but if you cannot put the same value continuously, isn't it? Just like if you're asked to calculate the value of the car, if you keep on putting 8 lakhs, it is not correct, isn't it? Now, what is the current value of the car? The current value of the car is only 6 lakhs or 6.5 lakhs. You have to exactly mention 6.5 lakhs. So if you say 6.5 lakhs is the value of the car, that is a net, that is equal to net product, the net value. If you are saying 8 lakhs is the value of the car, that is equal to gross product. So in the same way, the country, one of the concepts used in national income is either it can be referred as the gross product or the net product. So the gross product is what was the actual value of all the assets that has been continuously used. Net value, if you want to know the exact value for this particular year, exact value of the asset, exact value of the goods and services produced in a country for this current year, then we have to calculate the net product. So how do we arrive at the net product? If you deduct the depreciation charges, so the user charges them. So for example, if from 8 lakhs to 6, why, how the value of the car becomes 6.5 lakhs? Because continuously you have been paying the service charges, that user charges, that is called as the depreciation charges. The value of the asset depreciated, the value of the asset degraded, that is what is called as depreciation. So if from the gross product, if the depreciation charges are deducted, then we will arrive at the net product. So the first point you have to note down is the difference between gross product and net product is depreciation. So the gross national product minus depreciation gives the net national product. So the concept may be gross national product, net national product, or gross domestic product, or net domestic product, whatever it is, that please make a note of it. The difference between the gross product and net product is you have to subtract the depreciation from the gross product, then you will arrive at the net national product. That is the first point you have to remember. Okay, now again, the national income can be expressed as domestic product or national product, that is gross domestic product or gross national product, or net domestic product or net national product. Now what is the difference between the domestic product and the national product? So the domestic product is whatever the value of goods and services produced within the boundaries of the country. That means what, to put it very very simply, without any net income from abroad. Okay, within, for example, whatever the goods and services within the boundaries of India, then we calculate at the national income of India. So that is the domestic product. National product is whatever the value of goods and services within the boundaries of the country, within the boundaries of India, plus whatever the net income we are receiving from abroad. So what is the meaning of the net income from abroad? See, we are producing certain commodities and we are exporting certain commodities to the other countries. Okay, our laborers and all, they are working abroad and they are getting the incomes also. So all these are receipts for India. At the same time, we are importing certain goods from the other countries. They are all payments for expenses for our country. At the same time, other foreign nationals are coming and working in our country, and they are receiving the monetary payment which they are transferring to their country. So those are all expenses for our country. So the difference between these exports and import, the whatever the receipts we are getting by exporting the goods and services to the other country, minus whatever the payments we are making because of the imports and payments to the foreign nationals in our country, that difference is the net income. So if the payments from our side is more, if the imports are more, then that has to be deducted from the total national income of the country. On the other hand, if exports are more from our country, then that difference has to be added with the national income of the country. To put it very simply, domestic product, as long as the commodity or service is produced within India, okay, then that is added in the gross domestic product or net domestic product. And national product, as long as the commodity or service is produced by an Indian, whichever part of the world that Indian is, okay, not necessary within the boundaries of the country. So if the commodity or service is produced and earned income by an Indian wherever he or she is, then that is included in the national product. But domestic product, irrespective of Indian or whatever, it has to be produced only within the boundaries of the country. That is the domestic, within the country, domesticated. That's why it's mean. Okay. So second point you have to note down is the difference between domestic product and national product is the net income from abroad. So if you deduct the net income from abroad, then we will arrive at the domestic product. Or if you add the net income from abroad to the domestic product, we will arrive at the national product. So it can be from gross national domestic product to gross national product, or net domestic product to net national product. So that is the difference. So remember, the difference between gross product and net product is the depreciation. The difference between domestic product and national product is net income from abroad. Okay. Now the third difference you have to understand is the concept of national income. It can be expressed either at market prices or it can be expressed at factor cost. Okay. So that is gross domestic or national product at market prices, or gross domestic or national product at factor cost. Similarly, net domestic or national product at market prices, or net domestic or national product at factor cost. Okay. So the market prices, whatever the price which we are paying in the market when we are purchasing the goods and services. So that is the market prices is the rate at which the commodity or services is sold in the market. That is whatever the price we are paying for that particular commodity or service in the market, that is the market price. Okay. But the factory cost is whatever the value of the output at the factory level, okay, which is equal to the rewards paid to the factors of production. That is the total rent, the total wages, the total interest plus the total profit. So that is exactly equal to the cost of production. In fact, that is the correct national income of the country. If you want to know the correct national income of the country, we have to see the national income at factor cost. That is also not the gross national income at factor cost. The net national income at factor cost gives the exact value of the goods and services produced in a country in this current year. Okay. So the factor cost is the value of the output at the factory level, but the same commodity, when it reaches the market, then the value changes, because to put it very simply, so many charges are added when the commodity reaches the market, especially the indirect taxes, isn't it? So if the indirect taxes are added, what is happening? The price of the commodity is increasing, isn't it? And at the same, there are two things you have to note down here. One is the subsidies given by the government, and another one is the indirect taxes paid by the firms to the government. Okay. So this is make a note of it. The difference is indirect taxes and subsidies. So how we are saying, so this is the difference. Difference between market prices and factor cost is indirect taxes and subsidies. Let me explain to you how market prices differs because of the indirect taxes and subsidies from the value of output. Okay. Now what is the value of output at factor cost? Rewards paid to the factors of production, as I mentioned to you, that is total rent plus total wages plus total interest plus total profits. Okay. Now value of the output at market prices is equal to value of output at factor cost plus indirect taxes minus subsidies. Okay. So this is the difference. Now indirect taxes is something paid by the firms to the government. So if the indirect taxes are paid by the government paid by the firms to the government, now what happens? The prices will increase. Okay. So hence the price increase than the actual value of output. I am explaining you with example also. Just make a note of this. Hence the price increase than the actual value of output. So what happens? The indirect taxes have to be deducted from national income at market prices to arrive at the national income at factor cost. See, for example, let me give you with a numerical example. So I am taking the same example, pen. Okay, we have already taken pens at 10 rupees. So let us assume the price of good, that is pen, rupees 10, the quantity is 1000 anyway. Okay. So now how the rupees 10, this is the price per pen. So let us assume the cost of production for the producer is equal to rupees 8. That is whatever the rent is paying, whatever the wages is paying, whatever the interest is paying, plus whatever his normal profit. Okay. So the cost of production for the producer, to put it very simply, so the cost of production for the producer happens to be rupees 8, plus he is paying 2 rupees extra to the government in the form of indirect taxes. So totally is the 10 rupees is whatever he is paying. So he is charging the 10 rupees per pen. But when you see what is the value of the output, as I mentioned to you, the correct value of the output is whatever the value of the output at the factory level, that is which is equal to the rewards paid to the factors of production. So that is equal to the cost of production. So the value of the pen is equal to rupees only 8. Okay, that is the value of output at factor cost. But when the commodity reaches the market, it becomes 2 rupees extra. So the price is increasing. So from the market prices, that is from 10 rupees, if you deduct the 2 rupees which is paid by the firm in the form of indirect taxes, you are arriving at 8 rupees, which is equal to the value of the output. So in other words, from the market prices, if we deduct the indirect taxes, we will arrive at the factor cost. Okay. Now next you take subsidies. Now what is the meaning of subsidy? Subsidy is like some kind of concession given by the government to the firms, encouraging the firm to produce a certain commodity. Okay. So for example, the government is giving so many concessions to establish certain educational institutions or certain hospitals in the backward areas. See, for example, if the government is encouraging a person, a businessman, to establish, or a doctor to establish a hospital in the backward area, so maybe the land is given at a concessional rate. Okay, that means what? The government, half of the rent will be paid by the producer, and the remaining half will be paid, 3/4 or 1/4 might be paid by the government. So the part of the cost of production is borne by the producer, the remaining part of the cost of production is borne by the government. So indirect taxes are something which the firms are paying to the government. Subsidies are something which the government is paying for the firm. Okay. So suppose the same thing, if the cost of production, let us assume the cost of production for the firm is the same as 8 rupees, the same pen example I am taking, and after this the subsidies given by the government is rupees 4. That means what? Actual cost of production is not 8 rupees. The actual cost of production is 12 rupees, 8 rupees plus 4 rupees. But since the firm is not paying this 4 rupees, since the firm's actual cost of production is only 8 rupees, the firm is charging only 8 rupees. But what is the actual cost of production? It is 12 rupees. Okay, so the 12 rupees is equal to the value of the output, but what is the market price? It is only 10 rupees. Okay, so that's why the 12 rupees, the actual value of output is rupees 12 per pen, hence subsidies have to be added to the market price. So 10 rupees is the market price plus this 4 rupees, sorry, it is not 8 rupees is the cost of production. Let us assume the market price is 8 rupees plus some, I am removing the indirect tax for the sake of convenience. So let us assume here the market price is 8 rupees. Okay, and plus 4 rupees if the firm adds, then here the market price is equal to 8, because the firm's cost of production is equal to only 8 rupees including the profit. Okay, but for the value of the output is equal to 4 rupees. Actual cost of production should have been 12 rupees, isn't it? So this actual value of output 12 rupees per pen, hence subsidies have to be added. So 8 rupees plus 4 rupees will give the 12 rupees. Indirect taxes 10 rupees minus 2 rupees will give the actual value 8 rupees. So, or in other words, what you have to understand, the difference between the market prices and factor cost is indirect taxes and subsidies. Indirect taxes have to be deducted from the market prices, and subsidies have to be added to the market prices to arrive at the factor value of the output at factor cost. Okay, again I repeat, the indirect taxes have to be deducted from the market price and subsidies have to be added to the market price, so that we will arrive at the value of the output at factor cost. That is the next point you have to note. I repeat again, the difference between gross product and net product is depreciation. Difference between gross product and net product is equal to depreciation. The difference between domestic product and national product is net income from abroad, and the difference between market prices and factor cost is indirect taxes and subsidies. So make a note of these 3 points. And also the next one you have to understand is, there is something called as, you will come across real national income or national income at constant prices. Okay, see now what is happening, every year we are calculating the national income of a particular country, but will the price remains the same? No. For the same commodity, the price might increase or decrease. There will always be fluctuations in the prices of the commodities. How we are calculating the market value of the commodities? Price into quantity. So if suppose if the quantity remains the same, but if the price increases compared to last year, then the national income will show an increase. So we will wrongly understand that the national income of the country has increased, but that is not correct, because the quantity remains the same. The national income is showing an increase only because of the rise in prices, isn't it? So in order to avoid that confusion, almost all the governments, they calculate the national income at constant prices. That is what is known as the real national income. Again I am giving you an example. Let us assume in 2022 the quantity of pens equal to 1000. Okay, in a particular country, number of pens produced is equal to 1000. Price per pen is rupees 10. So now the total value happens to be 10,000, isn't it? So this is for 2022. Now let us move on to 2023. So in 2023, the quantity of pens Q happens to be still the same 1000, but for some reason or the other, there is then assuming there is an inflation in the country, the price per pen has increased from 10 rupees to 20 rupees. Okay, so now what is happening here? The total value is showing 20,000. So when you compare the national income of 2023 and with 2022, we will come to an understanding that the national income of the country has increased from 10,000 to 20,000. That is not correct, isn't it? The national income is showing an increase only because of the price has increased, the quantity remains the same. So this is not the correct estimation of national income. So if you are calculating like this, this is national income at current market prices. So in order to know the exact status of the country, in order to know whether there is a progress in the country or not, what the governments do is they calculate the national income at constant prices. So how do they calculate the national income at constant prices? That is, they take one particular year as base year. Okay, so one particular year as base year, let us assume the 2014, whatever the price is prevailing in 2014, thus price is taken as base year, and all the other years that price will remain the same. Only the quantity which is produced in 2015, 2016, 17, 22, 23, 24, only the quantity will change, P into Q, isn't it? So the price will remain the same, whatever the prices that was prevailing in the base year, that is in 2014, and the whatever the quantity produced in 2022. So that will keep on changing. Okay, so here you can see the price will be at base year prices, that's what I have mentioned, PB. Okay, so for example, I've just assumed 2014. So now you can see that PB into whatever the PB is, the 2014 price multiplied by the quantity produced in 2022, then that will give you the national income for 2022. Now again, PB, whatever the price prevailing in the base year PB in 2014 multiplied by whatever the quantity produced in the country in 2023. So that will give you the national income for 2023. So like that, keep on. Then for 2024, price prevailing will remain same as 2014, and whatever the quantity produced in the country in 2024, that will give you the national income for 2024. So if we calculate like that, then we will know exactly whether the quantity in the country is remaining the same, whether the quantity produced in the country is increasing, or whether the quantity produced in the country is decreased. Okay, then we will know the correct status, progress or otherwise of a particular country. So that's why this is what called as the real national income. Okay, and as far as India is concerned, in every 10 years in India we keep changing the base year prices. Okay, suppose if you are taking 2014, then 2014 to 2024, that same price will prevail, and again from 2024 to 2034, the government is taking the central statistical organization is taking the same price. So in our country, every 10 years the base year price keeps on changing. So this is what is known as the national income at constant prices or real national income. Okay, now if you understand these basic differences, basic concepts, then it will be easy for you to understand all the concepts of national income along with the formula. Okay, now let us move on to the actual answer. It will be easy now for you to understand. Okay, so now concepts of national income. The first concept is the gross national product at market prices, that is GNP at market prices. Okay, so I already explained to you, price into quantity is the market price. So what it is, GNP at market prices is the current market value, that is whatever the price that is prevailing at the current year, of all goods and services produced in a country, including net income from abroad. So national product means you have to include the net income from abroad also. So when the total output produced in a year is multiplied by their market prices, that is price into quantity, prevailing in that year, we get the GNP at market prices. So the main components of GNP, see, we are dividing the entire goods and services produced in the country, because there are so many goods and services produced in a country, isn't it? So in order to simplify the concept, so all the goods and services produced in a country is divided into 4 categories. Okay, so those 4 categories are, one is the whatever the expenditure incurred by the consumer, that is the consumption expenditure. Whatever the expenditure incurred by the producer, that is the investment expenditure, that is for consumer goods, investment goods, then the government goods, that's whatever the expenditure incurred by the government in order to produce the services to the public. And the fourth component is the foreign trade sector, that is X minus M, exports minus imports. So this, if you divide the total goods and services produced in a country in these four categories, all the goods and services will be accommodated in this. Okay, so that's why the main components of GNP are GNP at market prices is this is the formula, C plus I plus G plus X minus M. That is where C is equal to the consumption expenditure. Then you will arrive all the market value of all the consumer goods, plus investment expenditure, we will arrive the market value of all the capital goods. Government expenditure, we will arrive at the market value of all the government goods. And finally, X minus M, whatever the net income we are receiving or we are paying, that will also be arrived by including the exports minus imports. So this is the these are the main component of GNP. And for your information, the main components of GNP itself you will get for 5 marks. Only the first concept you might get for 5 marks. Okay, so the first point, the concept of GNP at market prices. Now the second concept is GNP at factor cost. Okay, now what is the difference? I told you, now you remember the difference between market prices and factor cost. I mentioned to you indirect taxes and subsidies. So when the commodity at factor cost means whatever the value of the output at the factory level, isn't it? So when it reaches the market, the value increases because the indirect taxes are added. So indirect taxes are added. So what we have to do, from the market prices, the indirect taxes have to be deducted. Plus I already mentioned to you, subsidies reduce the value, isn't it? So that is again the value of the output is not correctly reflecting. So we have to include the subsidies. So that is what it is. GNP at factor cost is the total value of output which is equal to the rewards paid to the various factors of production. That is rewards paid to the rent, wages, interest and profit. So if we deduct indirect taxes and add subsidies to the GNP at market prices, we arrive at GNP at factor cost. So GNP at factor cost is equal to GNP at market prices minus indirect taxes plus subsidies. So you have to remember all these formula. You have to mention the answer along with the formula also. Okay, so if you understand that concept, so what is the difference between market price and factor cost, indirect taxes and subsidies, then immediately you can write the formula also. So GNP at factor cost is equal to GNP at market prices minus indirect taxes plus subsidies. Okay, now the third concept is the gross domestic product at market price. So what did I tell you? The difference between the national product and domestic product I mentioned to you. As long as it is produced by an Indian in any part of the world, it is the national product. If it is produced within the boundaries of the country, domestic, then it is the domestic product. So what we have to deduct the net income from abroad. Okay, so if you forget, again once again go back to the video, go back to the explanation. I have mentioned you what are all the differences. So gross domestic product at market prices is the GDP, is that part of GNP, because GDP plus net income from abroad is the GNP. So GDP is only part of the GNP. So GDP is that part of GNP which is derived within the country. Okay, I am highlighting it again, within the boundaries of the country, excluding net income from abroad. So GDP at factor cost is equal to GNP at factor cost minus net income from abroad. Then the next concept is the net national product at market prices, NNP. So again, if you remember the difference between the gross product and the net product. Remember the car we are purchased for 8 lakhs, now the value is 6.5 lakhs, I told you. So what you have to deduct here, you have to deduct the depreciation charges. Okay, so the difference between national product and gross national product and net national product is the depreciation. Net national product at market prices, NNP. So what is happening? The country's stock of fixed assets undergoes certain amount of wear and tear, which is known as depreciation charges. I told you all the assets of the country, that is the capital goods, the machinery, the infrastructure, all the assets of the country will, that is a usage, isn't it? So the value will not be the same continuously. The value keeps on depreciating. So that is what is known as depreciation charges because of the wear and tear of because of the continuous usage. Due to its continuous usage, if this depreciation charges are deducted from GNP at market prices, we arrive at NNP at market prices. So current only for this year, what is the value of the output in the country? Then we have to look at the NNP at market prices. So now I think you have understood why there are various concepts. According to the situation, the statistical organization uses all these concepts. Okay, if we really want to check what is the total value of output in the country only for this current year, then the statistical organization uses the net national product. If the statistical organization wants to know what is the value of the output produced within the country without any assistance from abroad, then it will look the gross domestic product or the net domestic product. So that's why there are various concepts used in the national income. Okay, so if this depreciation charges are deducted from GNP at market prices, we arrive at NNP at market prices. So NNP at market prices is equal to GNP at market prices, minus depreciation. Okay, now net national product at factory cost. So again, it is the we already checked with the GNP at market prices and GNP at factory cost, the same thing. NNP at market prices and NNP at factor cost. Same difference, indirect taxes have to be deducted and subsidies have to be added. Okay, so net national product at factor cost is equal to, this is also called as the national income. I mentioned to you, isn't it? So if we want to know the exact value of the output produced in a country for this current year, then we have to check the net national product at factor cost. So of all the concept, net national product at factor cost is actually called as the national income. Okay, so it is the total income received by all the four factors of production. The moment you see factor cost, that is equal to the cost of the factors. Change it. Factor cost means cost of the factors. So what is the cost of the factor? Cost of land is rent, cost of labor is wages, cost of capital is interest, the cost of the entrepreneur is the profit. So if you add all this, rent, wages, interest and profit, that is the factor cost, which is equal to the cost of production, which is equal to the value of the output, which is equal to the national income of the country. Okay, that is rent, wages, interest and profits. So it can be arrived at two ways. There are two formulas in this. So if you have to know the NNP at factor cost, one way is NNP at market prices. So from the NNP at market prices, you deduct the indirect taxes plus subsidies. That is one way of calculating. Or NNP at factor cost is equal to, from GNP at market price, from GNP to NNP, what we have to do? We have to deduct the depreciation. So minus depreciation minus indirect taxes plus subsidies, we arrive at the NNP at factor cost. Okay, now up to 5 concepts we have finished now. Now moving on to the 6th concept, which is personal income. Now the name itself says what is the personal income. See, there are one is for example, I told you factor cost, you take the example the total wages or total rent. Okay, so that is equal to the reward paid to the factor. Personal income is the payment received by each and every individual of the country. Okay, so there is a difference between the rewards paid to the factor. Everybody is not working, isn't it? So if when you're talking about the factor cost, only the people who are working, either in the capacity of landlords, either in the capacity of the laborers, either in the capacity of capitalists, or either in the capacity of producers. So one day their rewards are included in the factor cost. But when you take the personal income, people who have retired, they are also included. They are also receiving income, isn't it? So many ways people are receiving income, isn't it? Property, ancestral property, all those things. So many ways the people are income. So personal income is the reward paid to the total income received by all the people in the country, but before payment of all the direct taxes. That is the personal income. And the reward paid to a laborer is whatever the wages the company has to pay to the laborer, that is not equal to actual income which the laborer is getting when you look at personally. Okay, So the wages paid to the laborer, that is the factor cost, that is not equal to the personal income of the laborer, because there are certain things the firm is deducting before making the payment to the laborers. Finally, what actually the laborer receiving, that is the personal income. So that's what we are going to check out now. Now what is the personal income? It is the total income received by all persons in the country before payment of all direct taxes. Okay, that is the first point. Now the whole of national income is not distributed to the individuals. That's what I told you. If the factor cost, the national income at factor cost is the total rent or total wages the firm has to pay. This is the value the firm is getting. This much wages the firm has to pay to the laborer. But the firm is not paying. If the laborer has to pay some 50,000, if the laborer has to be paid from 25,000. That is the value of the output produced by the laborer. The firm is not paying the entire 50,000 to the laborer. The firm is not paying the entire 25,000 to the laborer. The firm is not paying the entire 1 lakh in the form of rent to the landlord. So there are certain deductions made by the firm. Only the remaining amount is paid by the firm to the landlord, to the individuals. So that is what we are checking out. Okay, the whole of national income is not distributed to the individuals. Certain deductions like corporate taxes, see the firm has to pay certain taxes to the government, so that part the firm will deduct before paying the salaries to the labor force. Okay, then next one is the undistributed profits. So whatever the revenue which the profit which the firm is making this year, so the entire profit, the entire revenue is not distributed in the form of rent, wages, interest and profit. So certain amount is retained by the firm for investment for use next year. Okay, so that much amount is not again paid to the labor force. Okay, undistributed profits. And then the next one is the social security contributions. Social security contribution, this is some kind of contributions made by the firm towards the social security of the laborers. Okay, see for example you take provident fund. See the provident fund is something which the firm is not part of the every month from the salary, a part of the income is deducted from the salary of the laborer, and then that is given to the laborer at the time of retirement in lump sum amount. Okay, so this is like a social security. So after the retirement they won't be earning, so that the laborer will be getting in lump sum amount. It is a kind of security, financial security to the laborer. That's why it is called as the social security contributions. Or for example you take, sometimes the laborers when they are working in the factories, they might meet with some accidents, so suddenly if they have to pay the medical expenses and all, what they do, so the firm will deduct certain amount that is called as gratuity. Okay, so every month part of the salary of the laborers, that is a part of the wages of the laborers, every month the firm is deducting. So that so to that much extent the individuals are not receiving, maybe they will receive after their retirement in lump sum amount. Okay, but every month when they are working they are not receiving that. Okay, so undistributed profits, corporate taxes, social security contributions, they are all deducted from the individual. Even though when you look at the factory cost, value of the output, they should receive. Okay, the wages should receive that much amount of money income, but that laborer is not receiving. Personal income, when you calculate the personal income, the laborer is not receiving. So all these are deducted from the national income at factor cost and from their salaries by their employees, and the remaining income is only distributed to the employees. So whatever the remaining income which the individuals or the workers are receiving, laborers are receiving, that is only their personal income. Okay, and on the other hand, the social security allowances like pensions, scholarships, etc., which are provided by the government or added, these are called transfer payments. Now who is getting the pensions, scholarships and all? Pensions are received by the people who are not working. Scholarships are like for example students scholarship and all, they are also not working. So when you calculate the national income at factor cost, so that is received by the people only who are working, isn't it? Wages are received by the people only who are working. Interest is received by the people. They are contributing something to the production of national income in the country, isn't it? But these are all, the pensions are all the people who have retired, now they stopped working, and after stopping working, they are receiving income. So factor cost is including only when the people are working and contributing to the national income. So when the people are receiving income, when they are not contributing to the national income, that is not included in the factor cost. That will not show in the factor cost. But personally, a person, individual, is receiving, because these are all the outside the factor cost. So they are called as the transfer payments. So you might get these transfer payments in 2 marks also. So transfer payments are some kind of payments made by the government to the individuals in the form of pensions, in the form of scholarships. Okay, so in foreign countries and all, you will get something called unemployment allowances. So unemployment, the name itself says you are not employed, you are not contributing to the national income, but still you are receiving the income. So how it will show in the national income at factor cost? It will not show. Okay, but personally you are receiving the income. So what is the formula for personal income now? Personal income is NNP at factor cost minus, you have to deduct all these things. So the laborers are not receiving all these things, isn't it? Undistributed corporate profits they are not receiving, minus corporate taxes, minus social security contributions, plus transfer payments. Okay, maybe this we are taking collectively. Some people are receiving the transfer payments, some people are not receiving all those undistributed corporate profits, corporate taxes, all those things. Okay, so this is the formula for personal income. Okay, now the seventh concept is disposable personal income. So now the people have received their income, but how much they can actually use, how much they can actually dispose, that is what is called as the disposable personal income. So as an individual, they also have the responsibility to pay certain taxes to the government. Okay, so after paying the taxes, whatever is remaining with the individual, that can be disposed of, that can be used by the individuals, either for saving or either for consumption. Whatever way they want, they can use. That is the disposable personal income. So it is seventh concept, disposable income, DI. It is the income left with the individual after paying personal taxes. Okay, so generally disposable income is spent for consumption or for savings, consumption and savings. So the formula is DI is equal to PI, that is personal income, minus direct taxes. So the remaining income DI is equal to consumption plus savings. Okay, so this is the seventh concept. Now moving on to the eighth one, real income or national income at constant prices. I already mentioned to you, isn't it? Now if the national income is calculated at base year prices, that is what is known as real income. So if the national income is measured by taking base year prices, then it is known as real national income. So normally the government takes one particular year as base year. Okay, that price will remain throughout. So I told you in India every 10 years we keep on changing. How each country have their own method. Okay, how the country is taking that particular year. So that particular year should be a normal year. It should not be affected by too much of inflation or deflation. The price level in the country should be normal. So that particular year will be normally selected as a base year, and that base year prices will be taken for the calculation of national income for the next couple of years. Okay, so this is why if the national income is measured by taking base year prices, then it is known as real national income. National income measured at current market prices does not reflect the real status of the economy due to fluctuations in general price level. I mentioned, you gave an example, isn't it? If the price of pen increases from 10 rupees to 20 rupees, how the national income increased from 10,000 to 20,000, that is calculating the national income at current market prices. So it is not reflecting the correct position of the country. Hence, national income is calculated taking a base year price, which is known as national income at constant prices. So this is the formula. Real NNP is equal to NNP for the current year multiplied by base year index, which is equal to 100, divided by current year index. Okay. Now the last one is the per capita income. So per capita income is nothing but the average income received by the citizens of the country. See, the personal income is the individual income received by each and every individual in the country, that is personal income. Per capita income is not the individual income, it is only the average income received by the citizens of the country. So what is the formula here? Per capita income is equal to total national income divided by population. Okay, and per capita income indicates the standard of living of the country. So if the country wants to check the standard of living, then immediately it can check on the per capita income of the country. So which is the total national income divided by total population. Because if the population of the country keeps on increasing, then the standard of living of the country will keep on decreasing. So that is the importance here. So okay, so now you have understood these are all the various concepts of national income. So based on this concept, now you must have understood what is the significance. So each and every concept is useful in getting so many information for the country. So accordingly, the statistical organization uses these different kinds of concepts. So from one estimate of national income, we can gather so many information. Okay, it reflects the so many aspects of a particular country. So that's why we are having several concepts of national income. Okay, so once again you go through the explanation also. I mentioned you certain points. What are all the difference between market prices and factor cost? What is the difference between gross product and net product? What is the difference between national product and domestic product? If you know those three, then the rest of the things will be easy for you. Okay, so hope you have understood this answer. If you have any doubts, please mention to me in the comment box. So otherwise, if you find this video useful, please like, share and also subscribe to my YouTube channel. Okay, so until my next class, take care. Bye bye.